the sake of time, we'll go ahead and get started. Thank you, everybody, for joining us today. I'm very excited to see the turnout. This is great. Just to introduce myself, my name is Charles Graves. I'm a Vice President of Business Development at FXCM, and I oversee our API support team and our systems desk. Joining me today are my colleagues, James, Trent, and Tom. And then floating around somewhere is one of my developers. His name is Valeri, and he'll be able to answer some of the more technical questions that you guys might have after the presentation about the wrapper, about our APIs, anything kind of related to that. But to get started, let's just jump right in. Today I'm going to be covering a bit about our APIs and market data solutions. So for the agenda today, or I should say, before we get started, there are some risk disclaimers that I'd make sure that everybody's able to read. This first one is to cover the idea that trading Forex and CFDs on margin carries a lot of risk. That shouldn't be foreign to anybody, but if you weren't aware, there is a lot of risk in trading a leveraged product. The next disclaimer is for third-party links. We will be going to a few different third-party links during the presentation today and during the demo of our API and the rundown of some of the strategies that we'll code. So just to say, we don't own those links, we aren't affiliated with them, and we can't guarantee their success or anything along those lines. So to get started, we'll cover kind of who we are, who FXCM is, in case you guys aren't fully aware. We'll talk about the rise of quant trading and industry trends. We won't dive too deep into that. I know that both our presenters earlier today really did a great job of covering the rise of quant trading and everything that goes along with it. After that, we'll talk about our API solutions and other technologies. We'll talk about our FXCM Pi wrapper. We'll talk about some things that go along with API trading, so like latency solutions and what you can do to reduce latency whenever you're using an algo or any type of trading in general. We'll also talk about all the different algorithmic trading venues at FXCM. Not everything has to go through an API. Not everything has to be programmed kind of from the ground up. We have a lot of different platforms and solutions that can make that easier for you. After that, we'll talk about market data, and specifically the market data solutions that we can provide each of you. We'll talk about why data is important just very briefly, and then dive into the different data sets that we have. We have live and historical, open, high, low, close for Forex and CFD data. We have trade tape or order flow data. We have sentiment data, which we call our speculative sentiment index. And finally, volume data. All of these are great data sets to use in conjunction with just general price data. And as part of attending the Algo Summit today, each of you will receive a 6-month sample set of each of these data products. So to jump in, a little bit about FXCM. So who we are a global Forex and CFD broker, and we've been in the business since 1999. We are a Leucadia company. In 2015, through a series of transactions, Leucadia became the majority economic owner of FXCM, and this is something that we find really exciting. Their kind of work with us allows us to build a better brokerage and to provide innovative technology solutions, APIs, quality pricing, and transparent execution that helps all of our traders trade this market. We have a lot of other services that we offer just very briefly. I'd like to cover those for those that aren't aware. All of our clients, and in fact, you don't even have to have an account with us. You can just register a demo account, have access to mobile trading apps, one-click order execution, live charting, different platforms, all of our APIs. All of that is available completely for free. You don't have to sign up for a live account. You can just register a quick demo account and access all of those. We also have a lot of educational offerings. We have weekly webinars. We have lots of different ways that you can learn more about the market, more about our technology and data products as well. We do have a pro or institutional division as well that we provide retail brokers, small hedge funds, and emerging market banks access to wholesale execution and liquidity. And we also provide high and medium frequency funds access to prime brokerage services via FXCM Prime. If you have any questions about any of that, feel free to come and speak with me afterward. I'd love to tell you about any and all of those things. But to get into the meat of things, algorithmic trading is on the rise. If you've been through the other presentations, that should not be a surprise to you. The fact that you're here should mean that it's not really a surprise to you either. JP Morgan does a really interesting study that it's in the 2017 and 2018 study on e-trading. And for 2018, it's a forward-looking survey 24% of the users that they polled are planning to increase their algo usage in 2018. So a quarter of people that they talked to said, I'd like to increase my algorithmic trading. In conjunction with that, 74%, almost 3/4 of trading, is expected to go through e-trading channels in 2018. These numbers are growing from the 2017 numbers, just showing that things are getting more important in the algo world. This is actually an article that Yves had in his slide earlier today. This is getting the attention of just about every financial publication in the world. Bloomberg has a great article about how FX specifically is primed for more algos to kind of enter the scene. But it's not just Bloomberg. We also see that across headlines from Financial Times to Wall Street Journal, across the board. This is becoming a more and more salient topic. But more than talking about just general industry trends, what I want to talk about is how FXCM is positioning themselves to try and make this a better place for retail traders or institutional traders. But more specifically, what we've found is that at the retail level, at the individual level, this is a really underserved market. If you guys have tried to go out and do this, you might have run into roadblocks like really difficult to use APIs with terrible documentation, or you might not have access to data, or if you do finally get access to somebody's API, they limit you to running like 10,000 data points a week or something along those lines, which is literally nothing whenever you're talking about tick data. So we have found that this is the future of trading, and so we want to be able to provide a lot of value to that community specifically, to you. And so that's what I wanted to talk about today more specifically. So first, to talk about our APIs, because that's how we'll be accessing everything. The benefits of an API, just to briefly cover it, the way that we see it is it gives you greater flexibility. We have what is an award-winning platform that is, in my opinion, the best trading platform that is out there today. But on that platform, you still have limitations because you're confined to what that platform can actually do. With an API, you have the freedom to utilize and analyze data in any way that you want. You can join data sets. You can do just about anything that you can think of. And it doesn't kind of limit you to the constraints of what we thought should go into a platform at first, or what some other broker thought should go into a platform. It allows for more complexity. So with greater flexibility comes the potential for more sophisticated analysis. As I mentioned before, you can combine different data sets. You can use Twitter's API to pull in sentiment from different tweets. You can combine that with pricing data. In a platform, you're really limited and you don't have the ability to do that. But with an API and using just kind of streaming pricing and that type of thing, you can combine those data sets and make your analysis richer, fuller, and much more actionable. You also have enhanced efficiency. You can streamline your code to be as efficient as possible. You can save time on analysis without having everything else that comes with a platform eating into compute cycles. Not everybody's going to be that hypersensitive to latency and to efficiency, but for those that are, that's a big deal. Whenever you have a platform running, you have the charts in the background, you have the account information, you have potentially like an an RSS feed coming in. All of those kind of eat up kind of compute cycles essentially, to where you can make things as efficient as possible whenever you use an API. So our API specifically, we actually have a number of different APIs. We're going to be focusing a bit more on the REST API today. It's one of the ones that we've recently released, and it is really the easiest one to use, which makes it more accessible. But we have an API that's really geared toward anybody or anything that you want to do. You can see our stats here. Most of the APIs are fairly similar. Our Fix API does offer more frequent updates, but it doesn't have historical pricing. It's just a messaging engine. For all the others, it just comes down to the compatibility of the language that it supports, or whichever format you're really the most comfortable in. REST is obviously the most I guess, easy to use in the fact that you can use just about any language and you can access it however you'd like. As long as you can use a WebSocket, you can connect to our REST API. We do have a lot of different trading resources that we'll cover. We have a GitHub that has a ton of information on it. We have real case studies for using our REST API. You can download open source code there. We have strategy examples that do everything from backtesting to execution of different types of strategies like range bound or mean reversion, breakout strategies. We have full documentation in PDF and Swagger format. Our GitHub is a place where you can get just about anything that you would ever need. We have an FXCM Python wrapper as well with full documentation that makes things much, much easier, and we'll cover that today and actually show you a demonstration of the wrapper that you guys will be able to download from our GitHub as we go. And then we also have market data solutions. So without data, you don't have an algorithm really, you just have the bones of a strategy. The market data is really the lifeblood of the algo. And so we'll talk about some of the market data solutions that we have here in just a little bit. We'll also visit the GitHub here in just a minute so that we can download some of those Jupyter notebooks and some of the, and look at the documentation. But one of the things that we're really excited about, and if you've attended the first meeting today, or the first presentation, is our FXCM Py wrapper. So the FXCM Py wrapper is an FXCM developed Python package that exposes all capabilities of our REST API via various Python classes. Yves mentioned this in his presentation earlier today. The Python quant group actually coded that for us. We joined forces with them, and they built a really beautiful Pythonic wrapper that makes things very, very, very easy. It allows for a convenient Pythonic way of interacting with the FXCM REST API on a high level without needing to know what goes into every function and how to call each individual table or anything along those lines. So as an example, this is some code that if you go on our YouTube page, we actually have a demonstration of, or a walkthrough of how to connect to the REST API without the wrapper. This code is everything that it took just to connect. That's not to pull prices, that's not to do anything else. With the wrapper, it turns it into just 3 lines of code, including the import. So it makes things much, much, much easier. Some important things to know about our wrapper before we dive into it a little bit later is that it is freely available to everybody. There's no need to sign up for anything. You can easily install it just like you can any other Python package via command line. You can just pip install FXCM Py and it's done for you. There's full documentation that's available on our website and on our GitHub. And one important note is that it is only compatible with Python 3 and later, or 3.4 and later, I should say. The Python wrapper is not compatible with anything 2.0. So that's something to keep in mind if you ever do run into issues. That could be the first thing to check. So the question of why would we choose Python? That's one of the questions that we get a lot whenever we talk about algo trading and why Python is really at the forefront of everything that you tend to see. It's the #1 language that we've found used in what we call the DIY algo community and in institutions as well. Python has a number of different libraries that already exist that make analyzing huge sets of data much, much easier. If you guys are familiar with NumPy, Pandas, all of those are incredibly useful for analyzing data, and we'll actually use Pandas later to pull in data frames and kind of modify our strategy and do a couple of things. And it's one of the easiest languages to learn. Anytime that we have somebody coming to us that asks about which language should I try, if they don't have a preference, Python's the easiest to jump into. It's certainly not the most powerful, it's not the fastest, but it does make things so much easier whenever you're trying to learn. And for a lot of people, that's kind of the gateway in. There's certainly not a mandate to use Python, and a lot of people prefer other languages. But for ease of use and industry adoption, Python tends to be the one that wins out. So whenever you have an API, we talked about a little bit about latency. I just wanted to talk about some of the solutions that we have for latency. So we talked about making your code super efficient with using an API so that you don't have to use a full platform. But once you actually send a message, you want to make sure that that's executed as quickly as possible. So for any true high-frequency trader, or one that attempts to trade news, if you guys have ever tried to trade NFP, you know the difference between instant execution and even a quarter of a second is the whole move. You miss out on the whole move. What could be a profitable trade is now you're on the wrong side and you've unfortunately faded the event in the wrong direction. So a lot of people come to us and ask about solutions for latency. And through an API, you can get latency down to, with standard internet, about 15 to 250 milliseconds. It's a lot better than it's ever been in the past. Internet's getting a lot faster around the world, but it's not quite good enough. So we have a couple of services that we offer that can help mitigate that. Co-location is one of the easiest to do. It is a co-located server inside NY7 in New York, where our execution servers are located. And it's essentially a virtual machine that you install your platform or put your algorithm onto, and you're in the same data center as our execution servers. The great thing about that is that it reduces the distance that the signal has to travel, which means you have much faster execution. The better thing is that it's very, very cheap. It's approximately 30 USD a month, depending. You can also get those for free if you do certain trading volume a month, but $30 a month to solve that problem is typically within reach. That gets your connection speed down to about 1 millisecond. It can go quite a bit under that, but 1 millisecond is kind of the top end that you tend to see there. For some that's not quite enough, we do have cross-connection available. For those that don't know, cross-connection is very similar to co-location, but instead of still using the internet to send the message to the trading server, there's a dedicated fiber line that connects your virtual machine server to our trading servers to where it is as quick as it possibly can be. There are faster technologies out there, but you're looking at thousands and thousands of dollars to be able to do that. Just to get it started up is thousands and thousands of dollars. So the co-location is a little bit more expensive, but at $200 to $700 a month, you are getting about as fast as you can get without really putting out a ton of resources. I personally use co-location. We have a couple of VPS offerings that are both co-located with our servers. Beaks FX and FX Colo are the two that we use. Apologies, that gets you less than 1 millisecond in execution time, and typically quite a bit under that. But as we talk about algorithmic trading and we focus on the APIs, because that's what we're going to be demonstrating today, I want to make sure that everybody takes a step back and realizes that there are lots of different ways to automate your trading, and an API is not necessarily the best route for you. So at FXEM, we have 4 specific different ways that you can actually trade algorithmically with us. We have our trading station platform. The language that we use there is Lua. If you've ever used that, it is an interesting language, but we have a couple of templates that get you up to speed very, very quickly. It allows you to easily backtest. The backtester that we have on Trading Station is one of the best. It does interbar trading, or it can backtest on tick data. It backtests on real spreads and not fixed spreads. It's a great backtester. We have an Indicore SDK that provides a ton of tools that make development easier there, but you are still kind of confined to a platform. If you don't need to do anything super complex, if you're just using technical indicators and automating that process, Trading Station is a really good place to start. And we have a couple of videos on our YouTube channel that walk you through having zero experience with just basic coding experience, but not even in Lua. And by the end of, I think it's 2 videos that are about 15 minutes each, by the end of the second video, you have a working algorithm that you can modify and backtest and start trading on. So I would encourage you guys to take a look at that if you're interested, or come speak to us afterward. The second is MT4. If you've spent any time in the FX industry, you are certainly familiar with MT4. It's a great platform for kind of scripting out algos in the fact that there are thousands and thousands of examples that you can just find readily available on the internet for free. I wouldn't encourage you to just blindly throw an algorithm onto your live account without testing it out first, but MT4 allows you to pretty quickly get up to speed. It uses MQL, which is a proprietary language for MT4. The limitation of MT4, though, is, especially whenever you're talking about algorithmic trading, is that it doesn't backtest on actual spreads. So the moment that you start a backtest, whatever the spread at that time is, that's the spread for every trade that's placed on the backtest. So you don't really get real market conditions whenever you backtest on MT4. So if you do choose to go that route, just keep that in mind. Next is our APIs, which we've talked a little bit about. The APIs are great because you can use any language that you want. You can really do anything that you want with them. And we've talked about the benefits of just APIs in general. Third, we have specialty platforms. We have a page on on fxcm.com that lists all of our different specialty platforms, and these are focused a lot on the algorithmic trading side of things. So each of these will accomplish kind of a specific goal in that process. We're integrated with Quant Connect, if you guys have heard of Quant Connect, where you can actually code your strategies on their platform, access data there, and they're integrated with us so that you can actually execute as well. There are a number of other different platforms that you can use. Some specific back testers. We've had some on there that you kind of drag and drop, or you kind of drag across different candles, and it will find the conditions of that candle series and create an algorithm automatically from that. It's an interesting technology. It's one that you want to be careful with it, but it's very interesting to watch. If you see a large drop and you get those conditions, it can just automatically create an algorithm from it. So there are a lot of different solutions that you can get from the specialty platforms page. But now I want to talk about kind of the meat of what's, I think, going to be the most interesting thing before we get to the demo, which is all of our market data solutions and the different data sets that we have, and the different data sets that you guys can access completely for free. So data matters a lot. I know that both presenters before me have spoken a lot about why data is important and why a lot of data is important. But with the advent of greater computing power, we can now find different trends, correlations, find a lot of different interesting patterns that you otherwise absolutely could never really notice. You can use data science methods or machine learning that allow you to do a lot more now. And really, data is the lifeblood of any type of algo. So where do people get data now? You can get it through exchanges, you can get it through data aggregators like Quandl. The problem is that it becomes very expensive, especially whenever you want to get down into the tick data realm of things. Getting tick data for equities or for futures is very difficult and very expensive. And finding end-of-day data is typically pretty easy, but as Yves mentioned in his presentation, it's not terribly actionable anymore. It's not something that you can really build something on. And then additionally, you have real-time data feeds that are individually kind of charged per exchange or per instrument. It becomes very difficult to find. On top of that, proprietary data is really heavily guarded in this industry, and finding something that's not just pricing data is actually pretty difficult to do. A lot of people use that for their own market making or use that for their own internal prop trading, and so they don't want to give away the moneymaker. And so it's difficult to find, and if you can find it, it's typically very, very, very expensive. So we looked at that and said we need data solutions if we want to be relevant in this area. So we have committed to doing exactly that. We are providing large, actionable, and affordable data. So the data that we have available, as I mentioned before, historical and real-time core FX and CFD pricing, trade tape, aggregated sentiment, and volume. So I want to talk about each of those as we go along. So pricing data is probably the easiest to get, but finding it in large enough quantities to use can actually be kind of difficult. As I mentioned before, some brokers will put a restriction on how much you can download or how far back you can access. But with FXCM, you can actually get all of our historical data completely for free. That includes tick data. The data can be accessed using any API. Specifically for tick data, you do have to use our Forex Connect API at the moment. That's the only one that will do historical tick data. That is coming to our REST API soon. It's just making sure that we're able to get that done in a way that doesn't completely break everything. The trading platform can also export any type of data that you download, or that you have on the platform. You can export it to Excel, put it in table view. You can also get a lot of these sample sets through our GitHub, and you just specify the time frame and the currency pair, and you're able to just download CSVs directly from our GitHub completely for free. You can also, if you have specific needs for data, you can email premiumdata@fxcm.com. that email will actually go directly to me, and we can talk about whatever data solution you do need. We're quite flexible and can do just about anything that needs to be done. For live pricing, for tick live pricing specifically, that can be accessed through any API, period. You can get that through all of our trading platforms. They can be exported to Excel, and all of that is completely free to access. For sentiment data, we have what's called the Speculative Sentiment Index, and it's a proprietary data set that's offered by us that is aggregated client positioning. It focuses on buyers and sellers, comparing the two and providing a ratio. A positive ratio indicates that there are more buyers, there are specifically more FXCM buyers than there are sellers. And I'd like to show you just very quickly what that actually looks like, how you can access it. So this is our SSI kind of login portal, and this is where you can get specific information about SSI. Sentiment in the retail market is used as a contrarian indicator, and as we look at this, you'll be able to see why. Whenever you see major peaks on the pricing, and I hope everybody's able to see this at least fairly clearly. Let me see if I can zoom in. That's not going to resize. So let's take this market peak right here where the prices start climbing. What happens, especially in retail trading, is as the market goes up, a lot of people think, well, it can't possibly go up anymore. And that is obviously not true. It can always keep going up. It can always keep going down. The joke whenever I first started was, well, the market can't go down anymore. The price has reached the bottom of my screen. And that certainly is not true. So if you see this peak here, this is the price. So is the market price of Eurodollar during this period. The shaded area is the Speculative Sentiment Index ratio, which is how many clients are now net short. And as that climbs, you can see that that net short continues to go up, or I guess down and down and down, more and more and more negative, which is how the Speculative Sentiment Index is typically used. You can use it as a filter for trading. So if, let's say I want to get into a long position in my algorithm, let's check Speculative Sentiment Index. Eurodollar is very, very highly long on a net basis. That could act as a filter of maybe I don't want to be long right now if that's where most people are positioning themselves, and vice versa. So it can be a way to kind of filter out some signals that could be less than ideal signals in another world. This also comes with an XML feed, so you can get all of this and then parse it through whatever algorithm you have, and you have all of this information that's updated on a minute-by-minute basis. We do have historical sets available for this data, and that is what you guys will be getting, is 6 months of historical SSI that you can use to find any type of correlation that you could really want to find. You can use it as a filter. You can come up with a novel way that we haven't even thought of. That's the great thing about kind of Firehose data, is that you can take it and run with it and do anything that you'd like. Yeah?
Where's the SSI?
I'm sorry?
How do we navigate the SSI portal?
So the SSI portal, it requires a login, and that is one of our premium data products. But it is dealinginfo.fxcorporate.com. But if you have an interest in accessing that, I would have you just email premiumdata@fxcm.com, and we can get everything set up. Let me hop back to the presentation here. And I ran that from the beginning, didn't I? Apologies. All right. So the potential uses for SSI, as I mentioned, filtering trading signals generated by other technical indicators. So you can use the current technical indicators that you normally do with your algorithm and just filter the signals that then come out of it. You can also look for quick changes in SSI. So if something goes from severely long to flips and goes short, that can be an indication of market reversal that you might be able to use. There are a number of different ways to use it. Right now we have on our GitHub freely available 1 month of historical data. As I mentioned, we'll give everybody 6 months of historical data. And then we also have additional sample data that we can provide upon request, and that'll be through premium data at fxcm.com, or just come speak to me about anything that you would need. Live pricing, as I mentioned, is in an XML feed, and it's updated once per minute with fields that include the long and short amount in volume, the long and short amount in the number of orders, the net SSI ratio, the SSI ratio. There are a lot of different fields that you can use to really analyze anything that you'd want. Cost and additional data, you can contact Premium Data, come talk to me after the presentation if you'd like, and we can discuss how much historical data you would need, what access to live data you would need. Just feel free to come speak to me. The next product that we have is our trade tape or order flow. So the trade tape stream allows you insight into retail trader behavior. The trade tape service streams anonymized information about every executed order, which includes execution price, quantity, instrument, direction, and timestamp. That is a live stream. It is not a minute by minute, but it is a order by order. You have the potential to identify strengthening of or changes in momentum through that. It could be used as a potential predictor of future prices specifically. We partnered with Ernie Chan, if you guys are familiar with him, and he wrote a blog post on the predictive value of sentiment, of trade tape or order flow data. It's a great read and something that is really interesting, and he used the same sample data that you guys will be using, or that you guys will have access to. Historical trade tape is, we have 1 month of data available in CSV format. On our GitHub, we have 6 months, as I mentioned, that we'll give to each of you. For live pricing, for live trade tape, it's available via fixed feed, and it sends, this is gonna be hard to see, I apologize, but it includes executed price, executed quantity, traded instrument, direction of trade, transaction timestamp, and if you do have any interest in that, please feel free to come speak with me. Just wrap up the last premium data product that we have, which is our volume data. And this allows you to discover if a market move is the result of strong or weak demand is one of the main uses of this. The data would be most beneficial for momentum-based strategies in general. Potential uses are to confirm strong market moves or identify false breakouts. And as with all of the other products, they're available on our GitHub, or we'll provide it to you after this. And it is streamed via JSON and updated every minute. It includes 32 fields, but mostly it's outstanding buy, outstanding sell volume data. So with that, I want to go over to the kind of practical session, or portion of the session. So for all of you with laptops, we do have the Jupyter notebooks that we'll be using in this available on our GitHub. So if you want to navigate there, you can go to github/FXCM. The first item there is FXCM Algo Summit, and that contains the 3 items that you will need to kind of follow along on your end. There's an EMA crossover strategy that you want to download. That's the IPython notebook, FXCM REST API demonstration, which we'll start here in just a moment, and then the configuration file, which is where you'll put your token so that you can authenticate and actually go along with us and use the API in real time. So in order to use the config file, so let me actually just click on that quickly. All that you'll need to do is open this in just Notepad or any type of text editor. Change your token here to the token that I'll walk you through generating here in just one moment. And then keep that in the same folder as the other notebooks, and you'll be able to follow along with us. So for actually getting onto the trading station so that you can download or so that you can generate a token, the first thing that you'll need to do is have either a live account or a demo account. The easiest way to do it is just to log in or to generate a practice account. And I'll just generate one here with us. And we'll be able to get started. As we're kind of getting set up, does anybody have any questions about anything that we covered just in that first portion about the data products, about any of the platforms or anything that we have? Sure. So with the REST API, you can use any language that you'd want to use as long as it can use a RESTful API. So if it has a WebSocket package with it, that's typically what's needed because the REST API that we have it's not just a RESTful API, it's also the streaming portion is a WebSocket. And so as long as it has those two components or can use those two components, you can use any language that you'd want. We just had recently somebody ask for examples in like PHP, for example, which is kind of an unconventional language to algo trade in, but you can do it. As long as you can access any REST API, you can access ours. So once you've generated a demo account, you'll want to go to tradingstation.fxcm.com and just grab those credentials and get logged in there. And whenever you log in, make sure to hang on to the password if you're copy and pasting, or make sure that you remember it, because we'll actually need it again to generate our token for the REST API. This is our new web platform. We just launched this back in March. It has a great little tutorial that'll walk you through all the different areas, but it's a widget-based platform with fully functioning live charting, live pricing, and has a number of different widgets that you can import into it. It is a really nice platform that is specifically web-based. Let's see. Zoomed in a little bit too much. In the upper right-hand corner, you'll have your demo account number. If you just click on that and then click on token management, you'll be able to enter your password one more time, and it'll generate a token. The important thing to know about the token is that it will only be displayed one time, and it will only be displayed on this screen. We don't keep any type of copy of the token on our end. If you ever lost that token, you would not be able to get it back in any way at all. But if you do lose it, it's not a big deal. You can go back to your token management. You can just revoke the token. That'll clear out the token. You can generate a new one immediately. Just copy and paste that into your program, and you're good to go. But just for security purposes, we don't keep a copy of that token on hand. So once you have that token and you get logged in, or you submit it into your config file, just place it right there. Make sure you have your fxcm.cfg or whatever you'd want to name it in the same folder as the Python notebooks that you'll be using, or if you're just using an IDE or anything along those lines, make sure you have it in the same folder as the Python file or whatever file you're using. So the first thing that we're going to do is walk through some of the functions of the REST API and show you how easy it is to get everything that you would need so that you can then create the logic of your algorithm. After we walk through the basics of the REST API, we'll walk through building a very, very simple EMA crossover strategy and then backtest that strategy and plot out all of our different, all the different results that we have. It's a super easy process. After this, we'll actually be creating a video that will walk through this. We'll walk you through all of these steps line by line and put that on YouTube. So if you ever do have questions, keep an eye out for that, and it'll be up there shortly. So the first thing that you'll need to do in order to use the wrapper is you need to install the fxcmpy library or package, I apologize. To do that, you can just pull up a command prompt. You can pip space install space fxcmpy. That will download everything, install everything. You'll be ready to go. Date time should be included. You shouldn't have to do anything special there. But for the first portion, all we're going to do is import our dependencies for this section. And then we're going to connect to the FXCM REST API by just typing in connection equals fxcmpy.fxcmpy. We're going to point to the config file that we have that includes the server, so you can choose whether it's live or demo. And it also includes our token, so that your token's not just displayed in your main code, so that you can kind of secure that area. And we're just going to execute that cell. The authentication process for the REST API can take a few seconds. It's just basically getting set up, getting you a bearer access token, doing the authentication, and then sending a response back letting you know that it was taken care of. So it can take, on that first startup, just about anywhere from 10 to 15 seconds for it to actually completely log in. But once that's executed, which it has now, everything from this point forward is instant. So to show how easy it is, we can just get all the instruments that are available to trade at FXCM by typing con, which is our connection, .get instruments. That returns all of the tradable instruments for your account. So if you have a different account than somebody else, you might see more or less instruments, but this includes all of our CFD information, gold, silver, all of our currencies. These are everything that you could possibly trade with FXCM. So on the platform, you actually do have subscriptions. You can subscribe to up to 20 instruments simultaneously. So the previous step, the get all instruments, or get instruments, is for everything that you could possibly trade. If you want to see what you can trade right now that you're currently subscribed to, you can use get instruments for candles. And you can see that that list is a little bit shorter. That's the 20 instruments that we're currently subscribed to. Those are the instruments that we could get all of our historical data on, that we could place trades on. If you need to trade something that's not on that list, you can just log back into the platform, subscribe to different, unsubscribe from one, subscribe to a different one, and you're ready to go. So the point, now to get to the point where you can actually do something useful other than just see the instruments that you would normally see whenever you log in. So we're gonna talk about pulling historical prices. It is a very, very, very easy process. There are a couple of different ways that you can do it. You can really kind of specify it to exactly what you want to do. So you can get just minute candles and print that out, and that will show you minute candles, and it gets, I believe, 10 without specifying anything else. So the last 10 minutes. If you want more than that, or if you want a different period, you can choose the instrument, the period, and then the number of candles that you'd like to get. So these are all the different time frames that you can pull. You can pull anything from 1 minute, which is M1 data, lowercase m1, all the way through monthly data. All of these come in both bid and ask, open, high, low, close, and then you also have tick quantity, which is the number of price updates that were in that candle. It's not true volume, it's just the number of ticks that came through. So if we want to get something different other than that M1 data, we can get Eurodollar daily data for 50 periods. And it's just as easy as putting in the parameters that you want to do. You can also specify a start and stop date. So if you don't want the previous or the most recent candles, you can just choose your start time, stop time. You can just pass those into the get candles command, and that will provide you with all of the data that you want. So for this, we're going from January 14th through May 1st, and you can see that we now have a lot more data. It is very, very, very easy to do. It doesn't require really a ton of knowledge, and you can get all the information that you need from the wrapper specific documentation. For real-time pricing, it's just as easy as doing anything else. All that you need to do is you can just subscribe to the market data, choose the instrument that you want to subscribe to, and then you can get prices for that. And you can see that this creates a data frame that continuously updates and continues to have something added to it. So if I run this again, you can see that there are more prices that have streamed in. These are all real-time prices for Eurodollar. I'm just going to quickly unsubscribe from that, and now those data updates will stop. So what we can also do, you can just define a quick function that will actually print these out in real time as they come in, so that you don't have to continuously rerun that cell. But this is just more of a visual way to show that all of these are just streaming in just as we're sitting here, and it's very, very simple to get going and to get all the data that you would need. So unsubscribe to that so that we don't fill the page. Next is interacting with the account. So at this point, we have pulled historical prices. We know how to do that. We know how to stream real prices. So we can now interact with the account by placing trades, modifying trades, and getting our open positions so that we can see what's happening. So getting your open positions is just using the command get open positions. Right now, it's returning a blank table, which means we don't have any open positions. I'll go ahead and just place a market buy order on Eurodollar, and we'll place just a few of those. So we've got 3 or 4 now, and if we get our open positions, we can now see all the different positions that we have. This can be displayed in a couple of different ways. So you can do the attribute .t after the get open positions, and that'll show you in a table view that's a little bit easier to read. Or you can get it in just kind of line by line each individual position. So just a couple of different ways that you can display that data very, very easily. And I'm missing the period every time. So now that we've got that, let's place another trade, but we can really specify how we want to place the trades pretty easily. So instead of doing a dollar-yen trade, we can do a pound-dollar trade. So we just specify pound-dollar. We're going to set that as a buy trade, so is buy equals true. In pips, we're going to set to false because we're going to actually enter, we want to enter the, for our limit, we want to enter the limit as a price, not a number of pips away. But if you wanted to set it a number of pips away, you could set that to true. Set the amount, our time in force is going to be good till cancel, and then we're going to set that at market. So we've got a pound-yen trade that is set at, the price of the limit is set at 150. And if we go ahead and run this again, we can see that we now have a couple of new trades on the right-hand side here, and we've got both of our limits set at 150. Let me grab this trade ID here quickly. So once we do that, we can actually also modify a stop or limit. So we can modify the stop, in this case, we're just going to modify the last trade that we did. So we're going to do get open trades, we're going to modify the last item, the most recent item, and then we're going to change the trade ID, we're going to use the trade ID that it'll get here. We're going to set in pips to false. We're going to set is stop to false since we're going to change the limit. You'd set that to true if you wanted to change the stop, and then set our new rate of 170. And then once we print that table out again, you can see that our stop has changed to 170 on the most recent position that we had. You could also specify by trade ID if you wanted to. This is just to get the last one. After that, you want to be able to close out orders, and it's just as easy as opening orders were. So for a specific trade ID, you can just put in the trade ID that you wanted to close, which I grabbed earlier. And we've now closed out that last trade that we placed. You can also close all for a symbol, which you can do from the platform as well. This just makes it easy to close out full exposure if you want to be out of everything. And so if we close that out, then we can go ahead and just check to make sure that we don't have any more dollar-yen positions, and now we just have that one pound-yen position that we had before. And finally, we can just close all positions, and if we still had dollar-yen, it would close across currency pairs. Here it just closed out pound-yen, so you can see we're totally flat. Not the most riveting thing in the world, but it shows how easy it is to be able to access all of your data, interact with the account, without needing to know any of the socket I/O in the background, without having to go learn a ton of new things. You just quickly look at the wrapper documentation and interact with the account. Honestly, as easy as logging into the account and clicking the buttons in the first place. So now that we've got that out of the way, I wanted to do a quick strategy and show you guys how easy it is to actually build a quick algo. I would say at the front of this, definitely don't use this specifically. It's probably not the best strategy in the world. It's just a simple EMA cross. You can modify it as you see fit, but for the purposes of this, I wanted to demonstrate how easy it is to get a strategy going. Here we're going to use the FXEMPy wrapper. We're going to use pandas, NumPy, and datetime. But the one thing that I do want to point out that's a little bit different here that is something that we discovered just a little bit ago. Whenever we were looking at potential solutions, potential resources that we could put out into the market, one of the things that we thought was, let's build a bunch of technical indicators that we can put into a library so that you don't have to just completely rewrite like a simple moving average. Everybody knows how to do that, but why should you have to spend the time rewriting it when you could just create a library? We were going to do that, and then I discovered that there's one already out there. It's called PyTI, or PyTI. It's Python technical indicators. And so I installed that. You can just pip install it, pip install PYTI. And it has 40 or 50 different indicators that you can just pass a data frame into, and it will return that data, but have it processed for that technical indicator. It's got everything from Bollinger Bands to MACD to moving averages, anything that you can really think of that's kind of a staple of technical analysis. They have that available in that library. It's a fantastic library, and it simplifies the process quite a bit. So for this, we're going to import the exponential moving average. We're going to set that, we're going to import that as an EMA. Next, we're just going to set the, pandas display so that we can see the full data frame. Otherwise, it's kind of hard to see, where some of the trades are placed. You certainly don't need this extra code in here if you don't want to look through your full data frame. But to get started, we'll just go ahead and import everything, and then we will set this and get connected to the FXCM REST API. As I mentioned before, it'll take just a few seconds for that to import and then to connect, and so we'll just give that a moment, and let's see. There we go. So the first thing that we're going to do is we're going to load our pound yen. We're going to be trading pound yen. We're going to do a daily candle, and we're going to start on January 1st of 2016 and run it until a few days ago, so on 6/10. We're going to load that into a data frame, and then what we'll be able to do is define our EMA strategy. So these next few lines of code are the entire strategy. The rest of this is just being able to backtest to kind of go through it, but this cell defines our entire strategy. It's very, very easy, especially using data frames, to be able to get the strategy kind of set up. So for this, we're using a fixed pip cost of 0.0911, which is where dollar yen was and pound yen were just a bit ago. Lot size is going to be 10, so we're going to be trading in 10 mini lots. We're going to set our EMA fast to 12, and we're going to set our EMA slow to 20. So all these are just parameters. Where the kind of real magic happens is whenever we send our MVA, we're going to create a column in our data frame called MVA fast. We're going to pass in our ask close price into the EMA function that we imported earlier, and pass in the EMA fast parameter. That's going to create, it's going to return a data frame that has been, that has had the EMA run on it essentially, and return that in a new column that we're creating called MVA fast. We're going to do the exact same thing for for the MVA slow column. And let me actually just print this out so that we can take a look at this data frame. So whenever we initially load all the data in, what you'll see is that we just have a bid open, bid close, bid high, a bid low, and then the same thing for the ask and the tick quantity. We're going to create two new columns, the MVA fast, MVA slow, which will help us analyze when one crosses the other. And then we're also going to set a signal and a position column that will tell us when we're in a position and when we're out of a position and how long we were in each of those positions. So when the MVA fast is over the MVA slow column, we're going to set the signal column to 1. So the entirety of the duration, while the moving average fast is above moving average slow, we're in a long position. So if you think about a moving average cross, when that faster signal goes over the slower side, that's when you want to enter long. Next, we're going to take that signal column that we just created, and we're going to look for when that actually changes, whenever there's a flip in that column. And that'll tell us when we enter and get out of a position. This will allow us to do a couple of things. Later, it'll allow us to know basically when we got in, when we got out, but it'll also allow us to calculate our profit and loss during each candle so that we're not just looking at absolute returns, we're looking at just continuous returns to see, or drawdowns, to see how volatile the strategy can be. So we'll go ahead and run that and then print our data frame, and I'll show you the new columns that are created. So here, you'll see that on the first, for the MVA fast and MVA slow, the moving average, the first few columns are going to be not a number because there wasn't enough data to actually calculate a 12-period or 20-period moving average. So after that, we'll now have data that we can start taking a look at. And so what we're looking for is where the moving average fast, which is this column, crosses above or becomes greater than the moving average slow. When that happens, our signal column is going to be set to 1, which we defined earlier, and the position column looks for any change in the signal column. So when it goes from 0 to 1, we set the position to 1. We know that that's the candle we entered on. It continues to check, and every time that the moving average is above, or moving average fast is above the moving average slow, it's going to place a 1 in this column, and then once it switches back, that's when we'll have the -1 in this column because it went from 1 to 0. So we now know the start and stop of the position, and we know in between the start and stop exactly what occurred there. So this is really enough to know that when you're in a position, and you could go through and kind of hand calculate this out. But at this point, we now have a strategy that's generating signals. It's not terribly exciting because you can't see kind of what's going on under the hood or what it's doing or how good it is. But at this point, we actually have signals that have been generated across this historical data set. So let's do a simple back test. This is not a great way to do a back test. This is only going to show us basically the profit or loss of each trade. So it doesn't show you how volatile the strategy is. It doesn't show you drawdown. It doesn't show you peaks or troughs. It just shows absolute returns. So we're going to create a list of the beginning prices when we enter a trade, the ending prices whenever we get out of the trade, and then we'll have a just running counter called profits. So we'll iterate through all the data frames, and we're looking specifically at the positions column. So when the position column when the position column equals 1, that means it's the beginning of our, this column over here. When that goes to 1, that means we've entered a trade, so we're going to grab the opening price of that candle. That's what this line here is going to do. Whenever it goes to -1, we're going to grab the beginning price of that candle, which is the same as the closing price of the candle before, whenever we would have exited the trade. And then what we're going to do is just take those prices, subtract one from the other. We'll multiply times 100. So we're on dollar yen or pound yen in this case, where the pips is on the hundredths place. So we want to get that in pips, not in decimalized format. Then we'll take the pip cost and lot size, just as you would if you were hand calculating out any return that you would just for any position that you ever take. After that, we're just going to add the profit or loss, and that's it. So as we iterate through that, you can see the absolute return for each individual position, and then we've totaled that up just in a running total on the last line where it says the return period is about $2,300. So over 2 years, this simple EMA strategy netted us $2,300, trading 10K lots. I would say this is a terrible way to look at things. This is an awful back test. Don't do back tests like this. You really want to take in so many more factors. So we didn't take into account slippage. We didn't take into account transaction costs, or really anything else that would go into this. So this is a very simplistic way of looking at it, but it's a quick way to just kind of see if something works. But there are better ways to do back tests. And we're not going to get into really complicated back tests where you would actually want to put something like this into production, but just as a way to show how easy it is to kind of visualize or see how a strategy works, or how a strategy is kind of created and how you can look at how good it is, essentially. I want to show a different way of doing that. So in this case, we want to be able to see what our running total is, or what our running account balance would be if we were to run this strategy on a daily basis. So we're going to set our returns to 0. This is just going to be our counter. And in this case, we're actually going to populate this data into our data frame so that we can then use it someplace. So if we pull it out into lists and everything, you kind of have to kind of glue things together later. If we just do this in our data frame, it keeps everything nice, neat, and in the same place. So for this, what we're going to do is we're going to create a new column that is difference in pips. This is a good visual way to see just how profitable or not profitable a day was for you. All that this is doing is taking the open and close of the day, multiplying it times 100 to get it into pips, and so you can see on a daily basis what the candle actually did. Next, we're going to go through the data frame, and we're going to look for that position signal again. And this is where you want to have signal and positions, because this allows you to actually do daily returns on a running basis. So as we go through, we're going to look for the signal of 1. before we run this, just run this so that it's easier to see. We're going to look for this position, and when that is 1, what we're going to do is take the difference in pips, which we'll create in just a moment, and we're going to multiply it times the pip cost and the lot size, and that number will be added to a running total of the profit or loss of the system. If this column is not set to 1, or if this column is 0, then we're not going to do anything, and we're just going to set our running total to itself and display it in the data frame. So what that will do, if we just run this one more time, we'll have a couple more columns. And here you can see the difference in pips, which we just created. So each day you can see how much it moved in pips. So you can see on some days it's 180, some days it moves 8.4. This is one of the things that Yves touched on earlier in his presentation, but this is why daily data or end of day data is not something that you necessarily want to use very often. Pound yen is a pretty volatile pair, and I'm betting that it didn't move 8.4 pips just in one straight line during that day. Daily data doesn't tell you a whole lot about what happens in between, and you're missing a ton of information. But just for keeping this manageable and kind of viewable in the presentation, we're using daily data. But you can see that on some days it goes up, some days it goes down. But the interesting thing, or where we start to kind of see the results of our process, is whenever we get to that first signal. So right here we have, on the first signal where we have a 1, we're entering that position, and then we're taking that daily profit or loss and adding that to our total running profit. So on this day, the candle went up 189.1 pips. We're trading 10K lots, so that's about, 90 cents per pip. And so on that day, we had $172 of return. The next day, we had 209. The next day, 363. And it looks like we had a pretty good run, but then on the third day or fourth day, dropped down to 204 in equity, then we dropped down a little bit more to 138, and you can see that our profit is now going negative because the price is dropping. What's good about this form of backtesting is the fact that now you can see what happens and where your peaks and troughs are in terms of returns. Before, we just saw that we lost $315, but we didn't see what happened to our equity in between. And when you're trading a leveraged product, that's really important. What happens in between those two numbers could be a margin call, or it could not, but you want to be able to have more granularity into what you're seeing there. And so through that, we can just continue down, and we can see that every time we enter a position, whenever we have a 1, our equity changes, and you can see in real time or at the end of each day what happened to your positions, so on and so forth. And it is the same figures that we got before, but now we have much more visibility into what happened. But more importantly, we now have a really cool way to visualize it. So what we're going to do is we're going to take this and we're going to import Matplotlib, which is a great just plotting library. And we're going to set we're just going to set the different axes. We're going to plot out the market movement for the period, and then we're going to plot out exactly what happened with each position when we entered and exited them. And we're also going to put the moving averages on there to see if it's kind of a sanity test to see visually, does it look like we're entering a position when they cross? Because if not, we've gone wrong somewhere. So we'll just take that and plot out the returns that we have. And what you can see is the red is going to be the market price. You can see the moving averages, maybe a little hard to see. Let's see if we can zoom in a little bit more. You can see the moving averages as they cross. That's where we're entering a position. So where you have the kind of purple or pink arrow, that's when we enter a position. Whenever you have the black downward arrow, that's when we're exiting. So you can see all of the different positions and what happened on each. The other important thing that you can see, especially whenever you visualize like this, is where you just happen to catch a good market move. Without this single trade here, from here to the top of this run, without that one trade, this is actually not a profitable system. And so you can kind of visually find out, which positions were really made or broke my system. And does that mean I have a good system or not? That's where you can get into more analysis whenever you actually have that kind of visualization, or you can kind of get in there and take a look without having to do a ton of extra work. So next, what we'll do is plot out our actual returns. And here you can see what happened to the account in between. So instead of just kind of a step every time that we had profit or loss, you can see what happens to the equity. And specifically, you can see that huge spike in equity right here, where, again, it kind of made or broke our system to just get into that one trade. But it's good information to be able to see. It's also pretty easy to plot a lot of different things using Matplotlib. This gets a little, I would say just a little busy, but you can also plot out your returns as they are, as they relate to the overall market trend or market prices and moving averages. So it's an interesting way to kind of visualize things. And unfortunately, I think that, I think we're out of time. But that is just a very quick walkthrough of the REST API. There's a lot more that we can actually cover. If you guys have questions or if you want to learn more about the API, if you want to learn more about anything that we covered or anything related that I didn't talk about, feel free to come speak with me afterward. Some of my colleagues are over here. Feel free to reach out to them. We would love to speak with you. And thank you so much for attending this session. I hope that you guys are having a good time and learning a lot, and look forward to all of our other presentations today. Thank you so much.